welcome. Today, we are going to talk all about market strategy, rate, and really just kind of dive deep because we're so committed to just kind of like chunking down what's really happening. And there's a few key points that we're going to dive into in the next 30 minutes. So the goal with these webinars is to give you tactical insight that will protect you and help you with managing your buyers in this market. So before we dive in, I'd like to introduce Tara Bradley. Many of you know Tara. Tara is my loan partner and has been with me for, I don't know, like a long time.
Yeah, it's going on a lot of years. We probably shouldn't talk about it anymore because I'm getting old.
Actually, Tara, I think one thing to note about you and me together is I hired you in the last big real estate market shift, and that was in 2007.
Yep.
Right. So here we are again. Now we're talking strategy. We're in a different market, but a similar.
Oh yeah,
market, right?
totally.
All right. Well, we're going to first start off by let's talk about what's going on with mortgage rates, specifically over the last kind of 4 to 6 weeks. And we thought it might be helpful for you to kind of see a few charts, visually see what's happened. The reason that this is so important is because if you have a buyer that was pre-qualified 60 days ago, and that lender is not monitoring interest rates and not keeping up with the impact of the debt to income ratio and the price point that they can qualify for with current market rates, it could potentially just blow up once they go under contract. So let's show you what's happening, and then we're going to kind of dive into a current real life scenario of one of our clients and show you kind of how we're taking and dealing with current market strategies. All right, so Tara, let's dive in. We're first going to just show I wanted to start with the 10-year Treasury because it's hard for the general public to monitor and kind of understand what's going on with mortgage-backed securities. But it is important to know that mortgage-backed securities are what drives long-term mortgage rates in our country. So that's how it works. But if you're looking for kind of like an easy, similar something to monitor, I would focus on the 10-year Treasury. Tara, tell me about that.
Yeah, so I think the 10-year, I don't know that you can even really easily find the mortgage-backed security market, just even by Googling. And you guys, even in the news, I think Kelly, you saw on CNBC yesterday, they show the 10-year Treasury yield, and mortgage rates follow this yield. So as the yield is going up, you can pretty much know that interest rates are going up.
Yeah, so let's look at this. Just to my point, like over the last 60 days, if we pre-qualified clients in July, which we did in July, August, and now we send them out shopping.
Yep.
And then today, they're going under contract. Look at the spread. And the way to read this is the lower the price down here, so kind of this green area right here. Oops. I mean, oops. Oh. Technical difficulty. Yeah. Okay. Oh, I'm doing last quarter. Okay. So, I got my new pen, I got my new board. It's all fancy. Okay. So I'm going to say, Tara, right here, July 31st. Tell us what this means with the yield at roughly what? 3.8, 3.9 in that range.
Compared to where we're at now, like what that means in interest rate spread?
Yeah.
Roughly.
Look at this.
Yep.
So what's the impact to mortgage rates just in that time frame?
A half to 3/4, depending on the loan program. In rate.
So if you were at 7.5%, it could be at 8.25% now, depending on the circumstance, obviously the credit score, the loan type, the day, the moment.
Exactly.
Yeah. All right. So let's kind of translate that over to, this is a mortgage-backed security chart. And I know it feels kind of confusing, but in reality, the bottom line is that mortgage-backed securities have not done well over the last 2 months, and again, are directly following what's happening in the 10-year Treasury. So when we think about just kind of on a high level, why is this happening, Tara? Like what's going on? Why is this happening?
I mean, sometimes I don't even understand, but I believe it's mostly due to the influx of money that was pushed in during COVID and, you know, trying to get inflation under control, the Fed being very hawkish about all of that, our economy in the meantime staying stable and not getting inflation under control. And
all of those reasons are absolutely what's driving this. We have not seen interest rates at 8% in our country since the year 2000. So we've had a long run of quantitative easing, which was essentially the federal government pushing money into the economy. And that all started kind of in that 2008 timeframe, and it lasted up until 2022-ish, you know?
Yep.
And now that they've taken their foot off the gas and there's inflationary concerns, we've got all kinds of things going into it, but the bottom line is interest rates obviously are up and it's impacting the market. Now, we're not here to say blue, 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 it's all bad, nobody should buy, because we all know that in times like this, yes, it's more challenging. Yes, interest rates are higher, but there's still opportunity. Why is there opportunity today, Tara?
Because there's less competition, because so many people are sitting on the sidelines.
Yes.
Right. So when rates were low, we had bidding wars, people paying over ask. And when rates drop again, probably what we can expect because there's pent up demand.
Absolutely. So today we're coaching our buyers through affordable strategies, and we're going to show you one. And this was actually a client who was pre-qualified back in July. So let's tell the story and let's bring up, this is Mortgage Coach. So this is the tool that we share with our buyers and our referral partners just to help to really kind of show strategy. We are all about strategy, and strategy is the one thing that this type of market needs. Back when rates are 2 to 3%, you know, there's not much real strategy. It's mostly just that interest rate. Most people can qualify. Yep. It's a whole different game. This market, this is a skill-based market. This is strategy, strategy, strategy. So Terrace, walk us through this client. He was pre-qualified, what, in July?
Yep.
Okay.
So
in July, what were the rates?
Right. So assume a 0.5 point lower than what we're seeing here. So it's important, you guys, to know that like we start with a strategy when a client is pre-qualified. Let them know what numbers are looking like at this point. And I stress to clients, as you're walking into houses, as you find a home that you maybe want to make an offer on, let's update your analysis. Let's strategize the offer on this house with your agent. Can we negotiate a seller credit? Has it been sitting on the market? Or maybe it just came on the market. We don't think there can be a seller credit, or it's a different price point. So clients are consistently updated as they move through the home buying process. So
in particular, kudos to the agent, because she called us. It was a Saturday. She called us and said, hey, this house has been sitting around for a little bit. I think I can get a reduction on the price. But is it better to do that, or is it better to get the seller credit? And we said, what did we say, Tara?
Seller credit.
Now we can use that money to really dive into affordable strategies and solutions. And that's what we did here. So she was able to negotiate a 3% seller credit on a $649,000 house.
So that opened up lots of options, right? We can look at the 2-year buy down strategy. We can look at permanent buy down, like taking a chunk of that seller money and really bringing the interest rate lower. We could look at eliminating his cost altogether, right? Just with his 3%, we were able to, he was still paying points for an interest rate, bringing the interest rate as low as possible while covering the rest of his closing costs and only coming to closing with his down payment.
So let's walk through in detail. This is our analysis. This is what we presented to him after we got the contract. Obviously, he'd seen this multiple times as he's out shopping, but let's look at the first scenario. So scenario 1, the 2-year buy down. This is doing what most real estate agents have heard about, the 2-1 seller paid buy down. That's what this was. And in this case, the way it works, as a reminder, is if the note rate on today's rate is, let's call it 7.875%. Using a 2-1 buy down, the first 12 months is going to be at a payment's going to be based 2 points lower than the actual note rate. So in this case, his payment for the first 12 months would be based on 5.875%. The second year he's into the loan, so the next 12 months, his payment is going to increase based on the 6.875% interest rate. And then the third and final year, his payment will be based on that note rate of the 7.875%. So in this scenario, his payment on that first year is about $4,200, and his cash to close would have been about $38,400. Now, a couple things about these 2-1 buy downs. They are generally seller paid, and let's say interest rates drop in a year. The way that the money works is that the dollars that the seller is contributing to the 2-1 buy down are held in an escrow account by the lender. And then every month, the lender's supplementing the reduction in the payment for that, in this case, 2-year period. Well, if in a year interest rates drop and it makes sense for him to refinance, the rest of the money that's left in that holding account or that escrow account gets applied towards his principal balance. So those monies are still there and they're not gone, which is one of the attractions to this kind of buy down, because everybody thinks interest rates are going to drop at some point. I do too. The question is when. So we don't know when, right? If we did, we wouldn't be here right now, right?
Yeah, exactly.
I mean, I'd probably be like in, I don't know, Tahiti maybe.
Yep.
Yeah. So 2-1 buy down here in column 1. Now, here's where we start to get creative. We're showing the 2-1, we're in the second column, we're showing a permanent buy down. And we combine that with a special program we have called Rate Buster, which is a 1-year lender paid buy down. Tara, do you want to walk us through this one?
Yeah. So in this scenario, we're doing, his rate will be 6.375 forever, other than using our Rate Buster to bring his interest rate for the first year to 5.375, which is paid by us. So we took more of the seller money to bring that interest rate down to 6.375, so that his end interest rate after year 1, after our Rate Buster, is 6.375. Keeping similar cash to close to the 2-year buy down, because that helps him really compare, cash to close similarity and where we can bring the interest rate to.
Love it. So in this case, based on his actual permanent rate, it's not going to adjust at any point in the future. And he actually gets a, freebie first 12 months because of our special Rate Buster program of 5 3/8. But really, he can expect going forward, outside of taxes and insurance increasing, $44.30 a month. That's scenario 2. Still cash to close, right, about 32 or 37.2. All right.
And I guess now, really quick, we'll see as we go in for the 2-year buy down. If we jump to column 4, you'll see the interest rate is similar. His end payment in the 2-year buy down will be $50.53. So just keep that in mind as we walk through this, because that shows you, what is it, like
$800
each year? Yeah, $400 each year that it goes up in the 2-year buy down.
Yeah. Okay, so now he was really focused on reducing his cash to close because he's relocating here from Texas, and he could afford the higher payment. So he was less focused on interest rate. And I think this is really a big part of the strategy conversations that we have. Everybody has their own story. Everybody has their own footprint, and being able to ask the right questions to make sure that we are structuring financing to help them meet their goals, not our goals, but their goals, is really the key here. So in this situation, what's so interesting is he really didn't want or care about the 2-1 buy down. He didn't really care about the permanent buy down. His pain point was reducing cash because he also has a house to sell in Texas. So walk us through. He ended up choosing in column 4 where it says closing costs. So this is the one he chose.
Yep.
This one right here. But this is what it looks like for the first year with our Rate Buster program.
Yep.
Okay.
Yep. And just, knowing that refinance potential is in the future, he just wanted to keep the cost as low as possible. So, and everyone will have a different opinion on how quickly rates will drop, right? Yeah. The break-even point between some of this stuff, between like a 2-year buy down and a permanent buy down, depending on the day, is about that 2.5-year mark. So if rates drop before 2.5 years and you don't do a 2-1 buy down, let's say, you will have lost money, right? If it takes rates longer to come down, well, then it's beneficial to go with the lower rate. So
yeah. So much unknown, but again, the numbers don't lie. Like, we can do the math and say, based on this or that or whatever's going on, here's here are the options, and then obviously just helping the buyer walk through them and understand them and feel empowered by it is a big part of what we do. Now, in this scenario, I think it is important to note that because we just rolled out this Rate Buster program, which is a reminder, is a 1-year lender paid rate buy down. That's on us. We're covering that for the first 12 months of the loan. So in this case, his actual interest rate is 7.875% current market rate. But for the first 12 months, he kind of gets that 6.875% payment of that 46.33, and then after the 12 months, it will convert to his actual payment, 50.53 in this case. This program can be used on FHA, VA, USDA, and conventional conforming loans, which really covers the majority of loans out there today. So.
Yes.
Anything else we need to know about Rate Buster or strategy before we ping out of this?
I don't think so. I mean, just going back to the point of, not knowing, right? I just really encourage clients, like, we just have to make the best decision we can right now, right? Like, we can't dwell on it if rates drop in 6 months or whatever, 5 years, and we didn't make the best decision that we could have made, but it's just, we got to make the best decision right now. What's the most important thing to you right now? Is it the lower payment? Is it the lower cost?
Yeah. One other thing I do want to make note of that real estate agents may not be aware of is that whenever the buyer is using some type of buy down, whether that's a 2-1 or a 3-1 seller paid buy down, or in our case, the 1-year lender paid buy down, they're qualifying at the actual note rate, at the higher rate. Whereas if they use the money as a permanent buy down, like in scenario 2, so if he was tight on his debt to income ratio, the permanent buy down may have been the better option. And that's why we really evaluate both based on the buyer, the price point. Are they trying to push price point? What's their debt to income ratio? Sometimes the 2-1 buy down doesn't make sense. What makes more sense is to use that seller credit if it's available on that particular home or in that area to buy that interest rate down to allow them to qualify for more. Tara, any thoughts on that?
Absolutely. No, I mean, that's 1,000% exactly right. I mean,
yeah. And then 2, I think, just as a reminder, what goes into a debt to income ratio?
So new mortgage payment, obviously, and then any existing debts that are coming in on their credit report, student loans, credit cards, car loans, any payments to the IRS, child support, alimony. No things like water or electricity, that's not taken into account, but all that other stuff.
Yeah. And HOA, that's a big one. So again, if we have somebody that was pre-qualified under a single family residence, and then they end up finding, let's say, a condo or a townhouse that has an HOA much higher than what we predicted, come back to the lender, whether it's us or the lender that the buyer's working with, and make sure that they're updating that pre-qualification, because people are pushing that maximum debt to income ratio, especially that entry-level buyer right now.
Yeah. Okay.
All right. So questions, thoughts. We've got about 10 minutes left. So what else are we seeing out there? Let's talk seller credit. How about that?
Okay.
Oh, I have to give it, there we go. I got my new pen.
Nice.
So we have certain markets, and obviously this is going across the whole nation, and we lend in 45 states plus Washington, D.C. So we are doing transactions all across the country. And because of that, I do think it's really important that when any lender is talking about seller credit, it is going to kind of go back to the real estate agent on what's usual and customary for that particular area. That house, like Tara said, is it first time on market? Is the seller coming out of the gate being very aggressive and already offering seller credit? Awesome. We see a lot of that as well, just depending on the area. But we also will run into some real estate agents that say, I'm not playing in that. This market doesn't allow for it. And it's just so interesting because sometimes the stats really do support some type of seller credit. Now, in certain, again, highly competitive area or situations, is probably not a thing. But if that house has been sitting, at least in our experience, when we see these contracts come in, if that house has been sitting, let's even call sitting, 30, 45, 60 days, it really does start to open up this opportunity for seller credit.
Absolutely. Or recent price drops. Like if you see that they recently, that's a good time to go in and try for it for sure.
Yeah.
And we,
and don't go in at the price drop. Do what that agent did
Yes.
on Tuesday and call it.
Exactly.
Because the price drop, the impact to the buyer is nominal.
Yeah.
As opposed to getting that money and utilizing it to buy the rate.
Yes.
Susan had a great question. So the FHA loan limits are not announced yet. Actually, FHFA has not announced the conventional conforming loan limit. However, most lenders across the country have rolled out a $750,000 conforming loan limit. So it's what right now, 726.2, I think, Tara.
Yep.
So you're going to see a little bit increase, but the official word will come from FHFA. Many lenders, like Cornerstone, we are already accepting locks and closing loans under the 750 conforming loan limit projection. But I haven't seen anything on FHA. Have you?
No, I have not. No.
It'll be here soon, usually kind of November-ish. Yeah. Okay, cool. And what else? Why does that matter? Because it doesn't feel like it's a very big jump. In years past, that conforming loan limit, sometimes we got, $60,000. Sometimes we were so excited. So now, like, whatever, 24,000, not a big deal. Why is it a big deal?
Well, I mean, it's just that next, leg up to be able to do lower down payment, have more flexibility in debt to income ratio than the jumbo financing does.
And it's an easier process for the buyer. So conventional conforming loans, you can go down to 620. It's difficult to get a jumbo loan down to 620. As you mentioned, lower down payments, you can do a 3% down up to a $750,000 loan with a conventional conforming loan. So again, just the flexibility, the ease of the process, the automated underwriting systems that are used in the conforming conventional world as opposed to jumbo. Jumbo is like old school. And it's not one size fits all, whereas Fannie and Freddie are kind of one size fits all. This is the guideline, those are the rules, and we're all, selling to the same rules. Jumbo, it's very different based on the investor, the requirements. Generally it's a 2-year tax return, W-2s. They're looking for more assets, more number of reserves, larger down payments, just a whole different approach.
Credit depth is a big one too. So much easier.
So what's going on with credit card debt? When we are looking at credit reports today, Tara, what are you seeing?
It's on the rise.
It is on the rise, as are the interest rates. That recently, it's like 24 to 30% now on credit card debt. And we're at the highest level from the stat I saw, we're at the highest level of credit card debt in our country that we've ever been at.
Oh.
Right. So when we think about strategy, though, there's so many strategies out there that can help people, especially if they bought their house prior to 2021. They're probably sitting on a good chunk of equity. So that could be something to consider. I know we're talking with a lot of our clients about either a home equity line of credit to tap into it, even a cash out refinance. Sometimes, even if they're at a 4% interest rate, depending on what's going on with that debt load and those interest rates, just doing a cash out refinance could make sense even at a higher interest rate.
Absolutely.
Or our closed end second. We just did a couple of those last month just for some clients who, again, had credit card debt and needed to cash flow.
Yes. And the interest rates are scary, right? 8% interest rate is scary. The interest rates on the seconds are scary. The interest rate on a cash out refi is scary, but so is the credit card debt interest rate. That is really scary. And it can get out of control. So even just coming and looking at the numbers, no obligation to pull credit or whatever, right? We're here to help people get in the best financial position they can. And it's certainly a topic of conversation when we discuss how much people should put down on a mortgage. Does less down, and if you have extra cash paying off other debt, I mean, that 1,000 times over makes the most sense. So something that we're looking at when we're pre-qualifying people.
We actually had that very scenario. So a client came to us that was already talking with a bank going through the pre-qualification process. And the bank told him that he could only qualify for X dollars. But he wanted to be here on price point. And they said here based on debt to income ratio. Now they used that with proceeds coming from the house that he was selling and having him do 20% down. When he got to us, we're like, well, let's back that up. Let's back it up. What's your goal? My goal is to buy at this price point. Okay. So instead of doing 20% down on the new house, we put him into a 5% down. Yes, he had to pay mortgage insurance for a couple of years, or will have to, but he was able to take the rest of that money, pay off debt, and now qualify at the higher price point. And now he was cash flowing. So he was like, oh my God, this is a great option, you know? And that's just like a good example of just how like the strategy is so important. And I know that you're like this because you and I are very similar, and we've been on this journey for a long time. But we get excited about the strategy.
Oh yes, yes.
We're kind of like nerds when it comes to that. Nerds, you know, the strategy nerds. But it's rewarding because we can really see it come to life and see it matter, you know, to the end result, the day they get their keys, and we know that we've done everything we can to structure the financing as best for them, you know, based on their goals. So, all right, well, we have about 4 minutes left. Give me a nugget, Tara. What do you got?
Well, the nugget is that what you haven't talked about yet that I know you wanted to talk about was the bigger opportunity with being able to renegotiate the mortgage, but not renegotiate the
price. Yes, thank you for that. Sometimes I have these brilliant ideas, but I do need somebody to get. You've been that for 15 years. Thank you. Okay, so here's my thought. And you guys are already seeing this in social media. Ryan Sturhan had it. Barbara Corcoran has it. Everybody's got it out there. But get it. Like, get your scripting down and your thoughts down. And if you're in social or you're doing video, which, hey, that helps SEO. But if you're doing video, you definitely want to do a video on this. And so essentially, the bottom line is, are interest rates up? They are. But this does bring such an opportunity because if you were buying in 2021, y'all know what was happening. Tara talked about it earlier. Waiving appraisal contingency, waiving the inspection, having to pay above list, no seller credit. Sales are down in our country. I think we're the lowest they've been since 2008, from what I said.
Yes, I think that's right.
Okay. So that means opportunity for buyers who can afford and qualify if they're using financing at these interest rates. Because as we move forward, you can't go back and renegotiate the price of a house or the terms of the house, and that's key. If it was $600,000, you know, 2 years ago, you're probably paying $650, having to come to the closing with the difference. And if that same $600,000 house is still that today, you're probably getting the seller credit. So net, you're still ahead in this market. But as we go forward with all of this pent up demand, as you mentioned, Tara, I mean, it's just sitting on the sidelines. It's just waiting. And when rates come down to, it's going to be couple tiers. We get rates under 7, kind of that 6.5, boom, that's going to start it. And then if we happen to get under 6, watch out. It's going to be pandemonium. It's going to be craziness because there are not enough houses in this country for the number of buyers. That's just it. It goes back to basic supply and demand.
So you get your $600,000 house now, and then you still have your house when rates drop, and you just go ahead and refinance. You're not out there scrambling to get a house.
Right. Or trying to compete. You know, back in 2021, Tara, remember, we had buyers trying to use down payment assistance, FHA, VA, and they had a hard time competing in that market. Well, today, that's the market. And those loans are readily available. We're selling a lot of them. And sellers are accepting them and giving seller credits in many cases. So.
Awesome.
All right. Well, hopefully you guys, this was helpful to you. Stay tuned. We're going to just try to do this every couple of weeks and bring current market updates and strategy. What's going on with rates? What do you need to know? And give you the tools and some nuggets to be able to get out on the street and have better conversations with your buyers. Our next webinar is going to be on November 16th at 10:30 Mountain Standard Time. We will see you then. Thank you so much, Tara. And thanks to Jill Bright, Chicago Title. Bye, guys.
Bye.